Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 20th of October. I'm Daniel Lam, your host for the podcast. The tensions between the US and China were grabbing the headlines last week, but the fourth plenum in China, scheduled to be held later this week, should certainly not be overlooked by investors. There will be key discussions centered around China's 15th five-year plan. It will show China's medium-term goals for 2026 to 2030. We expect it to emphasize upon the importance of growth to guide market expectations. Now, one reasonable figure would be average growth of around 4.7 to 4.8% during the period, in order to double the 2020 GDP by 2035 in real terms. So to achieve these, China is likely to be maintaining an accommodative macro policy stance. In our earlier podcast, we spoke about how technology and AI has been raising China's total factor productivity. Now, one interesting stat from the US is that AI-related stocks have accounted for 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending growth since ChatGPT launched in November 2022. Very powerful stat, isn't it? Well, of course, the China markets and the economy is not the same as the US, but the area of innovation will be something that the government will be building upon in the upcoming five-year plan, especially with the aging population and technology restrictions from the West. Now, China would like to support economic growth via its AI Plus strategy, integrating high-end technology into both manufacturing and services sector in order to achieve self-reliance in advanced technology and migrate upwards along the international value chain. Officials also stressed upon the importance of high-quality development rather than quantity, highlighting the need to boost services consumption as a domestic growth engine. We may see more spending to improve the well-being of the population, in addition to investing in innovation and clean energy. We can see possible emphasis upon the role of the private sector in the support for job creation, expanding the services sector, and to drive innovation. Now, of course, lately there has been some mild pullback in Chinese equities, but we do believe investors should consider adding in tranches to the Hang Seng Index, especially if it gets to the 24,000 key support level. The main concern here is the US-China trade tensions. But as we discussed in our podcast last Thursday, Trump is facing his own impossible trinity: fighting the trade war, soothing the slowing US growth, and not stoking inflation and therefore not derailing the Fed's rate cut cycle. Hence, we do see the trade tension risk to be subsiding gradually. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.